Right, relies.
Okay.
So this is Senate appropriations, and we're continuing our testimony from the legislative economist, Tom Gabet, on the January 2023 revenue forecast update. So, sorry
Okay.
for that brief interruption.
Everybody remembers exactly where we were.
No.
So, yeah.
Oh, yes.
No, but anyway, right, just to summarize, there are these two forces that are opposing each other. One's, foot on the gas, one's foot on the brake. Foot on the gas is winning right now. That's what's happening. So we're getting more money than we thought because of that. We're going to get more through the course of the year. It'll be general fund excluding healthcare about 110 million. You add in healthcare, then another 10 million, so 120 million. And T fund pretty much flat. A little bit less unique circumstances affecting that we can talk about, and then a bit more in the education fund because of consumption taxes, which purely inflation. If you have more inflation, sales and use, meals and rooms, purchase and use all just float up with it. Car prices have increased. New and used car prices have increased a little over 30% since pre-pandemic levels. So, per sale, we're just getting more money. Sales have been depressed because there are no cars available. Dealer lots are, really low, but we're still getting, some.
Is the total number of sales up?
What's that?
Total number of sales?
Sales are down, but the
What page
Price
for our colleagues
price
across
per
the
sales.
hall?
Yeah.
What page?
Oh, I'm sorry, that's page 33. This shows auto inventories on dealers' lots. But for this, we would be rolling, you'd see big increases in motor vehicle purchase and use that are much more significant. Although probably price would also be lower. So, but anyway, it just shows that when you have a tax that's based on price and you get inflation, we get more money. And that's happening in those consumption taxes, and that's why the ed fund, has something of an upgrade.
Senator Sears has a
Speaking of
question.
inflation and the ed fund, the common level of appraisal in many towns is way down. I mean, it needs to be redone. And there aren't enough appraisers to get redone. And obviously the inflation on the housing prices, how does that impact the ed fund, or is it just individuals who in towns where the appraisal's below 70%, let's say? Does this affect the ed fund, or does this just affect?
No, I mean, it definitely affects the ed fund. Again, not the part of the ed fund that's forecast here, but the part that we do forecast for in October, which is the grand list forecast, on which all of that is based. And the thing in here that's relevant to that is on page 26. There's a chart showing an economic metric that really corresponds closely to grand list growth with a lag of about 5 quarters. So this moves 5 quarters ahead of the grand list. We love indicators that give us some advance notice. Without a forecast, it's just doing, and it explains 98% of the movement in the grand list. So this is very specific to Vermont. It's FHFA data on home prices, a huge database, and updated fairly frequently. So we have third quarter of 2023 data, 2022 data. I wish it was 2023 data, and we'll have fourth quarter, sometime in a month or so. So what that's showing is enormous price growth. You can see here, year over year, there's a year over year change in this FHFA index, which relates closely to the grand list. And so this is the basis of the grand list forecast that we provided in October, and then are used to set the property tax rates and all that. So that's the highest growth it's ever had. You can see it going, this goes back 3 real estate cycles to 1984. And, there've been 3 big real estate cycles. This is the highest year-over-year growth in price that we've ever experienced.
So simply giving towns, wait another couple of years creates more problems.
Yeah, just to keep up with that kind of fluctuation. So this is 18, 19, 20, percent increases. It's, it's,
The only thing I can say, because we can't see the people next door, but this is very much an issue for finance and the CLA. And the problem is there aren't enough appraisers for the municipalities to do the appraisal. So
Right.
exactly how this can be moderated or dealt with within this environment is a topic that our finance committees and our ways and means committees are going to be considering about, because the current appraised value compared to what sales brought, and then you get into that coefficient of dispersion problem.
but it's exacerbated when you
Yeah.
get wild moves in
Yeah.
stats. And when it's going up steadily 2, 3, 4% a year,
The
something
point
that's
is,
easy.
the simple solution that some of my towns are looking for is just give us an extension. And I want to understand what, trying to respond to them. I understand the finance committee's working on it, but
Why wouldn't you just use last year's? Because this is gonna drop back downwards, same with things.
So the only thing I want to say is, we've only got about 25 more minutes. I think it's an issue that's broad, Dick. A lot of people brought it up, and you can't, even if you want to appraise, there aren't the appraisers out there. So, here's
I'm
Senator.
having audio, I'm yelling, you should be able to hear me.
Oh, we can't hear you.
3:00 tomorrow.
Yes.
We're taking it up. Also, the home value, if your home value's gone way up, but you're still income eligible, you may be getting it.
Because you're hitting
So
above that 400,000 threshold.
Yeah, we're
Yeah.
taking it up.
Okay, thank you.
So-
I was saying that you were.
Yeah.
So,
I know,
hear us, but because you're
just be talking loud.
Yeah, talk more loudly.
Just send Chittenden back and forth.
Let me just correct one thing though on this. This is year-over-year change. So the fact that this drops doesn't mean houses decline. It means they grow, the value grows less quickly.
Yeah.
That's the only decline, are these little areas
And-
here.
And
So
so are
most of the
these
price
your,
increase is gonna
are
stick.
these your numbers, that are the projection for the future?
Yeah, our numbers are
So,
projections.
so the green is your
That's right.
projection to the future.
That's right.
So you're projecting that by 2025, 2 years from now, is the first time that we're gonna
See a broad decline.
see a correction.
Yeah, and then the grand list will be 5 quarters after that,
Mhm.
Okay,
that you'll see the comparable.
but the high is 21% in 1 quarter?
Yeah. Year over year.
Wow, year over year.
That's a 21% increase in property values is
Staggering.
You
huge.
can see that in
In
CL
one,
overall.
in 1 quarter of a year.
yeah,
Yeah, it is, right, and if you look back over time, you get that picture. It's,
But we're not gonna see any drop back in prices in your estimation until 2025.
well, you will have parts of the market that are dropping back, but the way this typically works is it will still be relatively strong.
Yeah.
And it typically doesn't just disappear and you look at the other prior cycles and immediately go negative. The other thing about this real estate cycle is it was very atypical in that you didn't have a lot of new construction. Normally, prices start to rise, that's a signal to builders. They can make a lot of money building, so they start building. And it takes years to buy land, permit, to build something, and then to have it on the market. While they're building, prices go even higher. And then they keep doing more. Pretty soon you have too much housing, too much building. That's all those prior cycles that happen. And then the whole thing crashes because you have too much built. We don't have too much built. We had almost no new building.
There was no
Media
shit.
prices, so, yeah, those prices are rising, but to get it in gear, and then during the pandemic, who could get a builder, and trying to get a
Well, the
builder
governor
now.
shut down construction during COVID for 8 weeks, and then you could have only one contractor in at a time.
Yeah, but even like contracts, okay, so I was working with some contractors and some construction projects on, around COVID, and I told them, it's outside work, you guys come and keep going, we'll keep paying you if you keep, if you come. And they were happy, they thought this was great. About a month later, they couldn't wear their shirts that said, whatever building on the thing in public, because people were hounding them to come and do work for them. They didn't want to be seen with these shirts before all asking them for work. It switched like that, and the demand's been really strong ever since. So even with high interest rates now really taking a bite out of single family housing, apartment construction is booming. And other kinds of construction, non-residential and non-building construction are really strong. There's a chart on that as well in here. So the construction labor has not declined at all, and even is at pre-pandemic levels now. So it's one of the stronger areas of the economy, and you would think with interest rate increases, it would be really weak.
Interested in that, right, really.
Well, but the interest rate has changed the price of, if you were buying a home in January and were doing it with a 30-year fixed rate mortgage, and you looked at the total price over 30 years of what you would be paying, and bought that same house now, you'd be paying about twice as much. So you're looking at twice as expensive
Over the course
of the whole thing.
But that, you're talking about like a 3.5% interest rate
Or
compared
the
to
7.5.
7.5. Well, hell, 50 years ago, I paid 6%.
I remember thinking
It was double
12% was
digit. It was
gonna
double
be,
digit.
what was it
Well,
got?
at one point, it got to 18%
I know.
in business.
Yep.
So,
I'm just gonna.
Seven
so-
isn't bad.
but it was a lower
It's
initial
all
price.
relative.
Senator, it was a lower initial price, so now it's,
I just want to make sure Tom has an opportunity to get
Yeah,
through his presentation.
I can buy a car.
And particularly since our colleagues across the hall may be having questions as well,
Yeah.
we're sharing the witness here.
Only 45 slides to go.
Well, I'm not gonna go
He's
through-
not going through
Yeah.
all these slides.
And actually, the Q&A is, I think, the purpose of this, I can talk about all the things,
Can
but
you talk about Wile E. Coyote and when you think we're gonna run out of gas?
yeah, that's a good one. That's a good one. So that's on what page is
Page
that?
6.
Page 6. So that has to do with the timing of,
Are you asking questions, Senator Bray, and we're not hearing
amongst
you?
ourselves. But the conversation seems to have passed that slide, so I don't know.
that slide wasn't even part
oh,
of.
we're on this slide.
They're on page
We
6.
just went
This
by
was
it.
the
It
slide
wasn't
we were
changing
talking
at all,
about.
so I thought maybe I should just
Oh, I
make sure
see.
that
Who's
we're
controlling
keeping,
that?
we're seeing it. you're
Okay.
You know, I think we would have been
I'm
better
sorry.
if we all were in the same room,
Yeah,
Senator
tell,
Bray.
tell me.
I'll ask them to give on tomorrow.
Okay, all right.
I'm around tomorrow too, if they, I don't want to have to.
Well, they're hearing the presentation.
Yeah, if
so
they have
can
questions,
at
they
least do
can
questions.
contact me and see, but they were looking at that while we were talking.
Are we on this one now?
No, I think we're on Wile E. Coyote.
Number
I was asking
six.
when he thinks we're gonna run
Let's
out
go
of
to page
gas.
6.
It's got Wile E. Coyote.
I'm meeting my people on an intrusion.
Okay.
All right.
Good.
I can't see it,
you're out wide.
Keisha, Bill's not here.
Oh,
I had to anyway, so.
here, can I have a chair? Do you want this chair?
I'm fine.
That chair's empty.
That's fine. I'm on the windows. Okay.
All right.
I'll take the talking about the chair.
On the case you can have it, there are chairs over here, whether you can take down.
Some of them.
And there are chairs right there.
Yeah, nice chairs.
All right. Where's Senator Chittenden? Did you get lost coming across the hall?
Andrea, some are coming, there's like, this is 6, one page difference.
Okay. Is it
We're gonna stay over here unless we have a question.
Well, why don't you just sit right here in this chair?
That's page 7.
Do better than
I'll
emergency.
hear you perfectly.
Wow.
Next time we get a string.
We're feeling a little bit guilty that you may have questions and we were kind of hogging the witness here, so.
I wasn't seeing any.
Okay, all right, so if you have questions that we didn't hear, please take advantage, but we were asked, we're on page 6, and that's sort of like, when do we jump off the cliff?
We're
Right.
talking about timing
Yeah.
on this, and the contention by Larry Summers, who's been the Treasury Secretary and Harvard economist, the president of Harvard, and all the rest knows, been around the block with economic cycles, is his contention is that what's keeping the economy going is this spending from wealth and all this saved money from the pandemic largesse and some of the subsequent infrastructure spending. And that's being drawn down. And as that's drawn down, you get to a point of inflection where all of a sudden, like the cartoon character, I hope I'm not dating myself, Larry Summers, sort of the same vintage.
I relate.
You
to
get it, okay. But, he's chasing the roadrunner and goes off a cliff and he stays there for a second and then he drops. And it's that second of staying there, but it's a quick drop. So that is a risk going forward whenever you have highly elevated revenues and a risk of a recession that is, for the Fed, pushing on the brake harder, harder, harder. All of a sudden, it really does bite and you get an avalanche effect. That's particularly true with tax revenue sources like personal income and corporate. Those are backward-looking taxes. You're paying, estimated taxes based mostly on what your liabilities were the year before. A little bit of true up. A lot of people just base it on what was the year before. And your actual liabilities, things like with withholding for those that are doing wage and salary payments, like those are more current liabilities. But those liabilities can drop when employment slows and a recession occurs or a downturn occurs. And then the boomerang effect comes from all the estimated payments that are there. And all of a sudden, you're not just having lower current liabilities, you're getting refunds for overpayments that you made. And that can be a huge effect, even more in corporate than in personal income, but in both of those two sources, it's what makes them super volatile. And that's the kind of drop that Summers, I think, is referring to. He's talking about consumption, but that is the interplay. So we have all this wealth that's being, has been stored up and savings, and that's being eaten away at to keep consumer spending strong.
Couldn't you look at the state and we're somewhat in the same position? We're still working through all that federal money that came down. So my only worry is that we run out of that federal money about the same time that the people in our economy that built up savings during that run out at the same time. That would create a terrible cliff for us.
Yeah, that's kind of what it is, because state government's a part of the whole story and a part of the whole economy. So,
But we both got these wads of money that would come from different places that we're spending. And so I hope individuals do something different. I hope they're not at the same time.
Well, the only thing that I'm thinking, for those of us who are looking at taxes and revenues, and those of us who are spending, the challenge for us is to be careful that we're not building a base of ongoing spending obligations at a higher level than we can sustain based on what that unwinding end period looks like. On the other hand, you're going to have people say, well, you don't need to raise taxes because you got all this money. But if you're using one-time money and creating ongoing spending obligations, that gets you into a whole host of budgetary difficulties. So I think that's part of what we have to be very vigilant, and that is, what do we think is really, for example, one thing that you mentioned is this year we have significant interest or investment returns because we're sitting on a big pot of money.
and interest rates went up.
And interest rates went up.
Mhm.
Now, once we start spending down that money, obviously that's going to have an impact. And those are really time-limited revenues. at that higher level. And so that's gonna be the hard part, is knowing what is gonna be there, ongoing, and how much of it we really need. And I suppose it's better to err on caution and try to do more on one time, so you're not building up an obligation just to err on the plus side. But it creates the impression for the general public that there's a lot of money, and truly there is. But for us, in terms of decisions for how do we do those one-time investments, how do we, what they are, and then what are we building for the ongoing budgetary obligations of the state. So that's part of what you've been struggling with as well.
Yeah, and I think one really important takeaway, if you don't get anything else from this, is an understanding that a pre-pandemic dollar and a dollar now is not the same. It's so you're really getting maybe 15 to 50% less in purchasing power from a dollar that you have now, depending on what you're spending it for. So with some of the capital projects that are really pipeline constrained and things like it, you probably already had people coming back and saying, oh, that money you gave us to build thus and such, we need 25% more. And what are you gonna do? All right, it's, right now we have the money, we put it in. But so the effects of inflation, yeah, we have a lot more money, but the essential public services that money is used to fund are going to cost a lot more. And I don't know that on the expenditure side of the budget, that there's a same kind of horizon that you would need to really, you would need to do like a 5-year expenditure horizon to kind of understand how much less you're going to have down the road to actually do the business of state government. And so that's a really important thing to keep in mind. These dollars aren't the same. It's been a long time since there's been this kind of inflationary environment around a budgeting process. And it means that you need to go out farther, and you need to factor inflation into every single thing that's happening. Some of it will be below kind of the headline CPI inflation. Some of it's going to be a lot bigger, depending on what stuff you're using it for. But expect that wages and salaries lag. Typically headline CPI inflation. So, a big part of state government is paying wages and salaries for things. So all that should be considered as well.
One area Senator Burchett and I are both on transportation, and you talk about material costs increase, certainly when you got into paving, and workforce issues. So we're seeing that combined with a very anemic
Transportation.
yeah, well, it's down, it's a very minor adjustment, but nevertheless,
Well, it's
So-
negative, and then if you add inflation,
I know,
it's like in real dollars, it's a decline.
it really is, it
Big
really
decline.
is.
So
That's why we
and-
should probably think about a fee bill. No, we haven't done.
No kidding.
Well, I mean, the purpose is we have a statutory requirement, but that's a different topic. Other questions, Senator Gray?
For pre-existing debt that was at relatively low rates, like 2.5%. I mean, is there someone for whom inflation is actually, they are now, by being in debt, they're actually paying less and less and less?
sure, because you're paying back with dollars that you're obligated to pay in dollars, but those dollars are worth less.
Right.
So you're a winner. And there are winners and losers all over across the board. High inflation environments, low inflation environments, you're a winner in that.
All right, so who are the winners that have an impact on what we're doing in here in pros and finance? Is that a consideration worth keeping in mind?
Well, it would have to be very specific, so we can talk about either particular revenue sources, particular issues, but you would want to think through those. So obviously with things like consumption taxes, prices go up on stuff, so our revenues go up. big part of why the education fund piece of this, which is pretty much sales tax, part of the meals and rooms tax, part of the motor vehicle purchase tax, lottery, and a little bit of interest, which is now bigger than it used to be, because that's where that investment is, part of that investment income shows up. Those are going up just because of inflation. Our, you know, the number of things being sold is pretty close to what was expected, but the price of those things is a lot higher. So state gets more money. You know, but that's important to understand. Yeah, so putting things in real terms, that's different. Then taxes that are like per gallon or per unit, those are gonna really suffer because, you know, the physical volume change could be low. In the gas tax, we have two of those things happening. But for those that are on transportation committees, I'm gonna be talking to transportation committees tomorrow, so you might want to get more of the weeds on that at that time.
You coming in the Senate as well?
Yeah, first time
Ever,
I think.
No, it's not the first time.
for us in the Senate?
Yeah, but in the Senate side, but
On the
we were
Senate side.
talking earlier with Rich when he was
Since I was chair.
House Transportation used to have them come over there, but I've not done it on the Senate side. Anyway,
So, and
that is
another
scheduled.
question?
Yeah, so the kind of not the conclusion, but your new forecast, and it is up from July, or you do a forecast in
From July.
December? July, so, and that, is that just what I see on page 22, or are there other parts where where your adjustments are just in dollars?
What are you on, page 22?
Slide 22, yeah, page 22, that's state revenue update. There's 2 bullet points there. But maybe there's other places. So everything else seems kind of more macroeconomic stuff.
Yeah, no, then that's a whole revenue station, but the other thing is the very first page
Yeah, that's really.
is kind of
yeah.
gives you the bottom line, you
It's
know,
right there.
change
Oh, right.
there. So these tell you
Right.
general fund excluding healthcare up 110 in fiscal 23 and up 37.7. Fiscal 24, healthcare goes up by about 10 million, transportation's kind of flat, and then education fund up 29 and 11. So a note about fiscal 24, because you know, that looks like, oh, that's an upgrade, that's good. Yeah, it is more money than we thought we were having in July. But the change from fiscal 23 to 24 is minus 8.9% in the available general fund. And that is the largest decline in that fund in the last 25 years. That's bigger than the decline in the Great Recession, which was 8.1%. So it's a substantial change, and that's with a baseline that does not assume there's going to be a recession, a full-on recession. So just a soft landing kind of slowdown. So that could get worse. That's the Wile E. Coyote point. So people think it'll get worse.
Yes.
I'm looking at the CPI.
Yeah.
Page, please.
It's at the very bottom, right under.
Oh, 9, it's only page 9, and then 9 and then 10, but, so just, can you talk a little bit about this as it relates to we're seeing a lot of spending right now.
Yeah.
But there are pressures on income as a result of inflation. So can you talk a little bit about that relationship?
Yeah, so the spending in part is driving inflation, in part, the supply chains are. a
Why
huge
are we
part of it.
seeing the spending, I guess?
Again,
Yeah,
so much money is.
People are feeling that we're flush.
Not feeling, they're flush.
But individually.
Yeah.
Are salaries going up sufficiently?
Their savings rate is
So salaries have
And
been,
the savings prior because of COVID?
yeah, let's look at page 11.
All of that, okay?
The table on page 11, and this is sort of the broadest measure of wealth. So this is Federal Reserve data through the third quarter of 2022. So pretty current relative to pre-pandemic fourth quarter of 2019. So this is average household net worth by wealth percentile group. And the Federal Reserve just started reporting on the top 0.1%. It used to be the top 1%, which added those two together. But they try to keep the shares, sort of, even. But this says, let's go down to the bottom 50%. So this is half of the population. Only 1.9% pre-pandemic of total net worth, but that increased to 3.3% after the pandemic, because actually a lot of the pandemic spending helped the bottom end of the of wealth percentile distribution disproportionately. But their household net worth before the pandemic was $33,000. That's mostly a bit of equity in a house, probably a vehicle, or at least some equity in a vehicle, and a little bit of cash or a little bit of savings maybe. But that adds up to $33,000 per household. That is now $70,000. And again, that's not, go to the top 0.1%, average household net worth $104 million, went to $131 million. That's a $26.5 million increase, per household. And you can go right down the spectrum, but still that change from 33 to 70, 36,000 more in net worth. Now, not all that's liquid, so you can't spend all that. We've seen, so one of the first things that happened when people got money at the low end, paid off credit card debt. Credit card debt went way down. Now it's almost back up to where it was pre-pandemic. And, so again, that's the first area they're feeling, they're stressed, they're taking credit card debt on to be able to keep spending, but that's going to run out. Savings rate is also page 14. This is just savings relative to consumption. Again, it spiked super high, setting records during the pandemic. Everybody got money, they didn't spend it right away. Saved, invested, whatever. Now it's dropped way down to 2%. That's page 14. Yeah, good. You're ahead of me.
That's what's down to there.
Yeah, it's down to there now. So that's what's being used to keep consumer spending strong and to keep the economy growing in the face of higher and higher and higher interest rates. So that wealth, though, is real across a large strata. Some benefited, a bit more than others, but that's substantial. And we've never had that kind of. We just never had $10 billion dropped on the Vermont economy. We've just never been in a situation where that much money got shipped. So anyway, that's what's defending the strength of the economy.
Is this Vermont specific, or are
No,
we
that's
talking about, I was
national.
going to say nationally?
That's
if
national.
we compare that with Vermont.
No, the only thing, we don't have that same level of detail. And in terms of asset change in Vermont, the only thing that I have here is that page 32 is the bank deposits in Vermont. This is based on the bank franchise tax, which is paid on the prior 12-month average balance of deposits by each bank.
32.
32, yeah. And what we get in bank franchise revenue has a lot of credits that are deducted. Affordable housing credits are taken by the banks before they pay the bank franchise tax. So they deduct that from the tax. This information takes out the credits so you know what the depository base was. And it's, usually pretty flat. It's, revenue-wise, $12–13 million a year doesn't change much. All of a sudden, that's going to be $18 million. But look at the end there. The depository base went up by $6 billion in a short period of time between early part of the pandemic when money was flowing
This
in.
is Vermont Bank.
These are Vermont banks, so, and this is not all the money that's come in, because people don't put in deposit accounts, most, large holdings. But that's money that's in Vermont all of a sudden, so that's capacity. And that circulates within the state, it doesn't just disappear either, so, and it goes out of the state, and some out-of-state money comes into the state, but this is happening nationally, so that, the federal government spending was on a scale, our neighboring states and all the rest are in the same boat.
We haven't seen bank credit card interest rates drop as a result of this.
Fat cheap.
No, as the interest rates rise,
I
because the
know,
Fed's
just-
putting on, interest rates are going higher and higher. But anyway, that's a measure of wealth and savings and capacity that's state specific.
Yes.
So
Yeah.
it's there, yeah. that's
I have a question about the workforce, and right now the data, I think, show that there are 3 job openings for every worker. And we saw some real dramatic changes. I said with pandemic, I mean, there were a whole lot of things you couldn't get. There was no housing, there were no workers, and there was no cat food. So my question has to do with workforce and the extent to which COVID had an impact, because we were going to experience a demographic problem anyway. Baby boomers are retiring, and the next generation below is a much smaller generation. So did COVID result in more people exiting that might have been retired? We were talking about the number of people that work on ski patrols, and they're 70 years old, and they left and they said, I'm not coming back.
Yeah.
Is that
Definitely
sort
got
of
it.
what we're seeing, is that that fact that we had people that were beyond retirement, that maintained their presence in the workforce? Because we were going to have a smaller workforce just simply because of the change in just the size of the next generation.
Yeah, so when you say it's a demographic problem.
Yeah.
It's like,
No, I don't know if it's a problem. It's
Yeah,
a
because-
reality that we just had, the next generation was a smaller cohort of.
right, but the fact that people are aging, just in terms of how it affects the economy, is in Vermont, people 65 and over consistently pay more per return, per personal income tax return, than people under 65.
I didn't mean to imply they were poor.
Yeah, no, but I mean, when you say it's a problem in terms of getting workers. if
That's
you're
what I meant.
getting-
That's what I
yeah.
meant. The numbers, there are fewer
Yeah.
numbers, that's
Yeah,
all.
Yeah, so there are fewer, yeah, so retirements increased among older workers who saw life expectancy dropping. See, life expectancy rates don't drop by a whole year, hardly ever. Last time was the pandemic in 1918. And it dropped by a year, 2 consecutive years in a row. So it went down 2 years, so people, and older people were much more affected by the pandemic than younger people, deaths and everything, hospitalizations, everything. And at the same time, your net worth's going way up. So like, what are you waiting for? Yeah, you're gonna like,
You could run for the legislature.
you could run for the legislature
I'm
now,
retired.
and you might even finance it yourself.
We are, it's almost.
Yeah, but that's a recipe for early retirement, and we've got a lot of early retirement, so not a surprise. And then also people, the illness, that chart that was up while we were talking about real estate, the chart that was up next door about illness, I think it's like one of the earlier ones. Let me just get the page so okay, that's page 5. This is another way, and these are not, these are people that are in the labor force, so they're employed, but they have a work absence due to illness. And the highest reading was the Omicron variant that hit about a year ago. That was the most transmissible at the time. So hospitalizations weren't as high, but you had this huge spike in illness, work absence due to illness. But it hasn't gotten down anywhere near where it was pre-pandemic.
You didn't check it out to see if they were really ill.
I didn't check it out, nor did the Bureau of Labor
So
Statistics.
Senator,
Well, I was curious if there's any way to break it down or know more about personal illness or family member.
This
This
is
is
due
also
to
for-
personal illness.
So you can probably double that
Yeah,
for
you can
someone in
double
your
that. People-
family.
Yeah, you gotta take care of somebody.
Yeah,
Right, and then there's people that you have to take care of permanently, so people that leave, and people that, you know, the children weren't going to school, they were then staying home with their children, and they said, you know what? I'd like to do that, you know,
yeah.
or I'll homeschool them, because I also had that happening. So, all of that has reduced the labor force. But what's interesting is we have 13,600 fewer people that are counted on payroll employment now than pre-pandemic. And yet, if you look sector by sector at the GDP output, it's higher, even in real terms. So we have 12% fewer leisure and hospitality workers. If you go to the chart before that, is page 4, shows the change in employment from February 2020 to November of 2022. Everybody's indexed at 1. And you see leisure and hospitality is all the way down like about 80, 88, 89% of where they were pre-pandemic. But look at meals and rooms revenue. We're like, you know, setting records. Maybe the service isn't as good. Maybe they're cutting back, but they're making money.
Service is better.
Service is better, okay, there's our small
I mean,
sample.
Where are you going?
Anyone that's ever run a business knows, if I had 4 people out in the shop working, it was terrible.
They're talking to each
If I
other.
had 3 out
Too
there,
busy to talk.
the product went up, the output went up. 2 was the actual
I guess
best
then I
one.
ought to downsize the committee.
So we don't need workforce, it sounds like.
We had 7 over here and they got 11 on the other side, so,
Look how much more productive you guys are, right? Is that what you're saying?
well, I think.
I'm not
we-
sure that I want to venture there.
We turn out good product.
Yeah, but anyway, it's real, labor force decline is real, and actually Vermont's, we have more of a decline than the nation, and the nation's now replaced all the workers lost in the downturn of the pandemic, and is higher by about 1 million to 1.3 million. But you know, Vermont and Connecticut, and Massachusetts and Rhode Island are all a bit below, but Vermont's further behind than any of those states. And Maine is positive about like the nation, which is kind of interesting.
They were
I'm not sure why.
Zero, too.
They were number 1 in terms of their demographics. but-
Yeah, but they have almost 1% more higher employment, payroll employment than they did pre-pandemic. And New Hampshire's like even. But Vermont is on a harder time. It's hard to explain because those states are also old states. New Hampshire and Maine are also, demographic profiles are quite similar. So there could be data anomalies and things like that. That employment also isn't counting people, you know, that are maybe working as independent contractors, subcontractors, working remotely, that don't show up in those data. We've had big gains in remote work that have persisted though by, I mean, it's hard to quantify, but we ran some numbers with tax on first-time filers. Those are residents and non-residents. So a lot of times there's always money from that. It's maybe 15 to $18 million a year. Now it's about $40 million a year. The last 2 years, 35 million and 40 million. So there are a lot of people that are working long enough in Vermont to be
Have a tax
paying
liability.
tax, have a tax liability, and some of them are first-time filers that are new residents. We match those up
Those
with.
aren't captured in your earlier statistic in terms of workforce overall.
No, a lot of them would not be. Who
It would
knows how
not be.
many
That's what I
are
thought they
ours,
said, yeah.
but a lot of them would not be.
Yeah.
If you're working remotely and you're independent contractor, you're working for company that's in New York,
Sure.
but you're in Vermont doing it, those stats are really hard to come by because they're collecting them at the company level. And then these other states are also trying to keep that money as well. So there's,
That's why in the census, half of the growth in my county's population was in Stowe.
that's right, that's right. And that was just capturing the edge of it because 2021 was even bigger move. The early 2022 census read was completely flat, but 2020 and 2021 were big increases. And I think you kind of need to average those probably to get a sense, but it's all unfolding. So we're trying to like keep up with stats and everything else to get a clear picture of what's happening. There've been a bunch of local towns that have tried to talk to us about forecasts of school enrollments because they're not sure if it's going to be permanent or you know what, and some are affecting your area, Rich. And the data have just been so slow from census, it's hard to know. We can't really run models without hard data, and the anecdotal data is just too soft.
Yeah.
Anyway, it's
Hard to
a
make.
real thing, yeah.
It's
And
hard to make policy on anecdotes.
but $40 million of tax revenue that we see from first-time filers, and we matched up individually this set of payers with property transfer tax purchases. So we can see those that bought houses and were first-time filers and how much they paid in tax. That's pretty remarkable set of numbers too. Those are taxpayers you want to have.
I was gonna say, I bet the characteristics of the
Yeah.
households' income will be on the
Yeah,
higher end.
it definitely is on the higher end, and we've seen a lot of income growth in that area. Yeah.
Other questions?
Well,
Dick, you have a question?
one brief, the federal debt ceiling. I listened to that, I don't know why I listened to that on the way out on MSNBC.
Just impressed.
It was on and
Impressed,
I
yeah.
could have been listening to something else.
Yeah.
Yeah, well, not classical, but something. But I was listening to it, and I mean, they were talking about how catastrophic that could be for the US economy. How would it, you know, is there any, I mean, here, we're in the middle, I mean, I think it's next week we reach the debt ceiling.
Yeah,
Again,
but they've got 6 months or so.
Well, but
It's all blowing smoke.
Now, we haven't done a deep dive into it because every time this has happened, they, come down to the wire and then something gets done and, and again, there are ways to extend and on and on and on. But it is a ridiculous exercise in, shooting ourselves in the foot. Really, if you want to control spending, do it before, when your decision is made, not after it's approved and then you're just hitting the ceiling. But anyway, we haven't done a run on that, but it would not be good long term, it's even worse, So we'll see how it resolves.
okay.
we'll just wait and see. It's Senator
If it gets
McCormick,
bad,
thank you
then
for
we're-
joining and you have a question.
Good to be back.
Yeah.
Yeah, if someone is doing work from home in Vermont for a New York company, New York office, they're plugged into the computer in New York, who do they pay income taxes to?
They're supposed to pay, if you ask our tax department, they're supposed to pay taxes to Vermont for the amount of time that they're working, proportional to the amount of time they're working there in Vermont.
Do we have a way to
Enforce that? No.
know that?
No.
It's like so
And-
much self-declaration.
We check their computers.
I thought it was all the locators from the vaccinations we did.
Yeah, right. No, this is a problem and the other states are pushing back. They're trying to say.
It's a New York company, he's working in New York electronically.
Yeah, that's
Because
right.
that poor worker can be taxed, how many times can you tax that?
Well,
That's gonna
there
be
have
huge.
been individuals who've, paid both because they felt they should get a refund from one or the other, and they didn't want to be not paying and being hounded by the other. And then they're really caught in the middle because until the states resolve something, they each keep the money, so
They all-
it's a mess. But we are getting money from
Mass.
people there. I don't know how many are contested or anything else.
Does that figure in your projections about the future for?
Well, the first time filer data that we had was the only time we've gotten hard data on it. I was surprised how big it was. So
Is that this
20
chart?
million. Yeah.
Yeah.
Yeah, that's it, right, table 28.
And we're gonna have,
28.
the tax
28.
department will be.
Is our tax rate higher than, the city?
New York City?
Yeah,
Oh, no, not higher than New York.
right, so why would they choose, elect to be here if the rate is lower?
Right, right.
If they worked here. yeah.
It's just that they ask their corporation, where do I pay my taxes? And the corporation might tell them, do it in New York.
Actually,
But the
become the
individual can
major
say,
league
I'm
baseball
working from
players
home.
signing contracts.
Yeah, it's a messy area.
Florida and Texas.
Thank you.
Go back.
So,
There's real
we
money.
need to
Yeah,
take
it's
off
important.
revenue
I know.
without tax.
You have 330. I think the house, you're supposed to go to the house, is that right? House
Where's-
donations.
It's time to go.
Yeah,
Oh.
I think so. We used our
Time to
time.
go.
All right,
Time to
well.
go.
And
So your ending results is spend as much as you can.
Don't say,
No, spend it all.
all right.
Tom, this has changed over last year.
Percent change over year ago. Yeah,
Year
so
ago.
that's on the total year, so, yeah. But you see how that's increased.
Yeah,
It's
it's amazing.
pretty substantial. And it's not that we have so many more numerically, but they're paying a lot more. They're a lot wealthier. So they're doing more substantial stuff in the state, highly likely to be remote work. Yeah,
you're
so,
not constructing.
They're not too good a year to be
They're
nobody.
not working at Dollar General, that's what they are.
no, although
Well,
as
so that's-
single-family housing slows, maybe you'll find a few people
So
willing to do some work, but
Um,
no,
digital
building-wise,
services,
construction markets are
Emily,
hard.
I want to check and see
No way.
digital
They pay
services.
big money, plus the supplies are plywood.
Still, I mean,
Oh,
that's
we have
gone
digital
down, up
services
and down and up and
Yeah.
down, but yeah.
So I'm
We have,
gonna
I'll
take my,
I
I'm
tell
gonna
my
take my
boys
vacation
at
out.
home.
Let's
they
go.
Retreat. Yeah.
We're going to retreat now.
Strategic
Thank you
retreat.
very much.